We've got Vance Ginn with us right now, the chief budget economist under Donald Trump, an economist now for the Texas Public Policy Foundation. Vance, very good to have you. You know, we now know that inflation wasn't and isn't transitory. In fact, could go on for some time here. We do know as well the lift in interest rates could go significantly higher than we thought 6 months ago. So I'm going to put you in the tough position of then factoring out these next 6 months, because that has grown to be the scary consensus that we're in for a lot of hellish inflation and a lot more rate hikes and a potential recession. Do you think that's in the cards?
I think that is in the cards, and unfortunately that's what we're seeing from the bad policies out of Washington. Whenever you overregulate something like the Biden administration has done, you overspend like Congress has done, and you overprint money like the Fed has done, these are the results. And as it was mentioned earlier, this could be the worst year since the first half of the year for the S&P 500 since 1962, 60 years ago. At the same time, they were seeing the highest inflation rate in 40 years, and at a time when we're trying to celebrate our freedoms with Independence Days coming up, I mean, Americans are feeling this pain all around them because of high inflation and this stagflationary period that we're in.
Now the question is, are we through the worst of it? And now, obviously, we just had a read, not a final stamp on the first quarter, down 1.6%. We're looking at numbers right now that show personal spending, barely budging right now. So it's seeing the first signs that the rates of increase in that have slowed measurably. I'm just wondering how that plays. I mean, if we're in a contraction this quarter, that does meet the definition of a recession. So right now, do you think we're in one?
I believe we are. I mean, you saw that there was a downgrade even to first quarter GDP to negative 1.6%. Right. And the Atlanta Fed, they have this GDP now estimate. They're saying Q2 is about flat, 0.3%. And if you look at that latest number for consumer spending, you adjust it for inflation, it's down. It's negative. And so we're already seeing this contractionary sort of situation that's happening. And if interest rates keep going up, which I believe that they should, in order to get inflation rates to really go down, you've got to have interest rates be above the rate of inflation. And if inflation measured by CPI is 8.6%, we've got a long ways to go up in interest rates before things really get better.
I know we hit people with a lot of different monthly data here when we were looking at, for example, the inflation and all of this. There's a consumer price way of looking at it where it's running at an annual clip of about 8.6%. There's something called the core personal consumption expenditures, which the Fed, I'm told, follows. That's running at about a 4.8% clip. Either way, overnight bank lending rates that the Federal Reserve controls have to match that inflation rate. And whether you're looking at 4.8% or as high as 8.6%, that means we have a long way to go up in rates. How high do you think they go?
You're right. I mean, currently we're at 1.5 to 1.75% in that range for the federal funds rate, that overnight lending rate between banks. So we've got substantially higher to go. Right now, what you see is what the inflation adjusted rate, the real rate, is still negative. So that's still expansionary from that perspective. And when you look at the Federal Reserve's balance sheet, more than doubled since 2020 to $9 trillion. There's a lot of money that's sloshing around the economy. And a lot of that's now got to come out. And so you have asset prices that will need to deflate, as we've seen some of that with, stock prices, and the housing market might be another one of those shoes to start to drop. Small businesses are also dropping jobs of the last 3 out of 4 months, and that's just one of these sort of shoes to drop. And what I've called, the zombie economy, it seems like what we have right now.
Do you think that the number of rate increases or the degree to which the rates go up will not be as severe because it's already having the effect? It's bringing down market rates over which the Federal Reserve has no control. For example, a 10-year Treasury now is under 3%, and that could be reflecting the market's view that things are slowing down, will slow down, and they're putting money on it, and then that the Fed isn't going to have to be too aggressive. That's not, by the way, tonic for a lot of people. I mean, obviously, the implications are that we get a slowdown or worse, but what do you think?
Well, expectations matter. And so when we expect interest rates to keep going up, then people start to buy less today. So that will have some influence. But I still think we have a long way to go. When you look at the overall economy, we've had all this increase in demand from increase in the money supply, from buying all the Treasury debt that increased by more than $6 trillion over the last 2 years. And then the Biden administration, overregulating the private sector, too much money chasing too few goods, you're going to have more inflation. And I just don't understand why so many thought this was going to be transitory. February. It was clear this was going to be persistent inflation for a long period of time, so the Fed is well behind the curve. And unfortunately, Biden and this current Congress are not going to look at any pro-growth supply-side measures that would grow the economy.
And not to besmirch you, Vance, of course, debt was growing under the Trump administration, too, right?
This is true. It's something that we need to make sure that we start to get a handle on, because ultimately this debt is unsustainable. We're at $30.5 trillion now, but just over the last 2 years, there's been a 25% increase in that national debt. We've got to get control over it.
Right, and just the higher interest rates that we're looking at now has added about $130 billion in interest rate costs alone, and that's just with the few increases we've seen. Vance, very good having you. Thank you very much.